Hello everyone, this is Jennifer. So we are going to start with inventories in this particular video. So inventories in the AS standard 2. So what does the standard basically tells about inventories? Inventory is nothing but the stock that a company uses. So it basically prescribes the accounting treatment for the inventories. This particular standard deals with the determination of cost and its subsequent recognition as an expense, including any write down to net realizable value. So, first of all, what is written down? Written down is nothing but the value of an asset writes down every year, which we term it as the depreciation for the asset. Okay, so net realizable value is the value that an asset can be recognized when it is sold. So it is kind of a market price, a current market price for the asset after writing down its expenses in the sale. So this particular standard deals with the determination of cost, the cost of purchase of the inventories, and its subsequent how it has been recognized in the books of accounts as an expense after writing down to accounting to its net realizable values. It also states or provides a guidance for the cost formulas used to assign cost to the inventories. So what are the cost formulas we are talking about? So everybody knows about inventories cost formula, which is the FIFO method, LIFO method, and the weighted average cost that we use to compute the cost of inventories. So basically, according to the standard, we only use the first in first out method or the weighted average cost formulas. So what is the scope? This standard does not apply to the following kinds of items. The first one is work in progress arising from the construction contracts. So the work in progress which are from the construction contracts cannot use this particular standard for estimating the cost of inventories. The financial instruments, then the biological assets. Biological assets relates to the agricultural activity produces or the mineral and mineral products, etc. at the time of the harvest, and the producer of agriculture and forest products, the mineral products, all this will not come under this particular standard. And also the commodity broker traders who measure their inventory at the fair value less cost to sell also cannot estimate the value of the inventory under this particular standard. So how it is measured basically according to this standard, as I've done the sums, from the sums itself we get to know whichever is lower we estimate that to be the cost of the inventory, either the cost or the net realizable value, the historical cost or the net realizable value, whichever is lower, that is being measured as the cost of inventories. So cost of inventories, all cost of purchase, it includes basically the cost of purchase, cost of conversion, that is nothing but bringing the asset to the proper condition into the present location. It would include the freight charges, cost of consultants, transit insurance, any discounts if it is there, you will less it. So as I've done a sum, you will get to know about this. So this is how you estimate the cost of inventories. So there are few concepts that we'll just look into the meaning of it. So cost of purchase. The cost of purchase of inventories basically comprises of the purchasing cost import duties and other taxes which are recoverable from the entity, and it also includes the transport handling cost and other costs which are directly attributable to the acquisition of the finished goods, materials and services. The cost of conversion basically includes the costs which are directly relating to the units of production such as direct labor, etc. Basically bring the asset to the present location or the condition. Next you have the cost formulas. As I told you all, we either use the FIFO method or the weighted average cost method. The last is the recognition as an expense. So when inventories are sold, the carrying amount of those inventories will be recognized as an expense in that particular period in which the related revenue is recognized. And if there are any written downs, that will be recognized in the period the written down is done. So we're moving on to the next topic, which is the intangible assets. Intangible asset. So what is intangible asset? An intangible asset is basically an asset that is not physical in nature. Goodwill, like the goodwill, brand recognition, or the intellectual property rights, all these come under the intangible asset. So what does the standard talks about intangible asset? It basically talks about the treatment for intangible assets that are not dealt with specifically with another standard, but it is talking about the accounting treatment for intangible asset according to Ind AS 38. So it basically requires an entity to recognize as intangible assets. So which all is considered to be an intangible asset? How do you basically recognize the cost of intangible asset? Because it cannot be physically touched, it cannot be physically estimated. And what are the criteria which it needs to meet to become an intangible asset? So the objective basically talks about this, how an intangible asset should be recognized and should be measured. Okay, that is the objective of Ind AS 38. Cost of intangible asset basically includes the purchase price and the direct attributable cost. The purchase price includes the import duties, non-refundable taxes minus any rebates, and the direct attributable cost includes the cost of employee benefits, professional and legal fees if anything is there you considered, and the cost of testing the assets estimation. So scope, Ind AS 38 applied in accounting for intangible asset except the following asset. So it does not include the intangible assets held by an entity for sale in the ordinary course of business. So if anything that is held by the entity in the ordinary course of business, that cannot be considered under this particular standard, or it can be deferred tax asset. Deferred tax asset is when you pay your asset amount more than that estimated amount. For example, you estimated your tax amount to be 50,000 to the government, but you pay off 80,000. So this 30,000 extra is a is not estimated, it is more than the estimated amount, so that is considered to be deferred tax asset. All this is not considered under the standard. Or the lease agreements, or the goodwill acquired in a business combination. When two business combines together, an extra goodwill will be carried on. Okay, so that is not considered under this standard. Or the financial asset which are already defined in Ind AS 32 does not come here. then the deferred acquisition cost and the intangible assets arising from the insurer's contracts, then non-current intangible asset which are classified and held for sale is not considered, then asset arising from the contracts with customers like your normal regular contracts for the revenue from customers, that is not being considered, so it does not picturize all that. Then the identifiability, so which we will consider as intangible asset according to this particular standard. So the intangible asset is capable of being sold, transferred, licensed, rented, or exchanged either individually or together with a related contract, but not in the ordinary course of business. Or it can also arise from the contractual or other legal agreements. So, regardless of whether the rights are being transferred or separable from the entity or from the rights and from the actual rights and obligations. So how do you basically initially recognize and measure the intangible asset is it that depending upon the definition of intangible asset and whether it meets a recognition criteria. And when it meets the recognition criteria, you record only when it is as the probable that the expected future economic benefits that you reap out of this particular intangible asset flows only to the entity, and the cost of the asset can be measured reliably. So only when it is considered, all the incomes that you get from the intangible asset will only flow to the entity, and the cost of the asset should be measured correctly only when this too is understood and analyzed, and intangible asset will be recognized and recorded accordingly. Thank you everyone.